Hi, I'm Arish Shah, host of the Nothing Ventured podcast. As a CFO that has operated in the startup and scale-up ecosystem for the last decade, and as a founder myself, I found it absolutely essential to learn from those that have come before me. So this podcast is an exploration of the people, the characters, the stories, and the narratives that make the venture ecosystem go round. From emerging fund managers to established VCs, from angel investors to founders, I chat to people that make the tech ecosystem thrive. Please remember to like, rate, and subscribe to the podcast because it really helps with our discoverability. And in the meantime, I hope you enjoy the pod. In today's episode, I had Marcus Love with me in the studio. Marcus co-founded Love Ventures in 2020 to partner with exceptional founders to help them realize their vision. Love Ventures specializes in FinTech, PropTech, ConsumerTech at seed to Series A stage, and at the moment is in the UK. We talked about having to want to build a fund, needing a thick skin, and what it took Love Ventures to raise from 84 investors, having talked to 900. What are the things you need to think about if you're an emerging manager and looking to start up your first fund, choosing your partners wisely, and what to do when things get tough. Let's get straight into it. In today's episode, I'm really excited to have Marcus Love with me in the studio. Marcus co-founded Love Ventures in 2020 to partner with exceptional founders to help them realize their vision. Love Ventures specializes in FinTech, PropTech, ConsumerTech at seed to Series A and at the moment in the UK only. If you want to learn more about Love Ventures and indeed about Marcus, do check out the primer episode. In the meantime, Marcus, absolutely wonderful to have you in the studio with me here today.
Thank you for having me.
So let's dive straight in. We've talked on this podcast with a lot of emerging managers over the years. And the thing that comes up time and time again is how opaque raising a fund and setting up a fund is and the whole kind of business that surrounds that. What are the things that you would recommend new managers focus on getting right in the first place, especially given the evolution of Love, which started as a 1.7 million fund and has been growing since then?
I think there are three main things. The number one is hustle. You've got to really, really want to do this. Otherwise, I just recommend going and joining a larger brand VC, which could give you great access to investors and to communities and to portfolio companies. If you're coming out of an existing VC or have a demonstrable investing track record, it is easier. That is how a lot of VCs start. For others, it's harder, as you'll need to consider how you create your brand in what is a reasonably crowded space and how you differentiate yourself. And that's going to be key as you attract capital from investors. You're going to need to have really thick skin. So, you hear about hustle, but it's I can't, express how strong that is, that you need to be able to have a really thick skin because before coming onto the podcast, I had a look at our latest fund. And in our CRM, we had 900 rejections for 84 investors.
Wow.
And so it gives you an idea of how many times you get turned down. Now, I don't know if that's good or bad relative to others, but what I can do is say that to someone who's maybe newer to it or considering doing it, you need to get ready to be told no a lot. That said, it can be hugely rewarding because you're building something from scratch, and anyone that's been on an entrepreneurial journey themselves will know how exciting that can be. What I would recommend is obviously to leverage your network. If you've co-invested with others or have referrals, obviously that's a great way to be growing. We were successful at Love Ventures in leveraging our angel network and syndicate as we started out. We've leveraged tools like LinkedIn to show what we're doing. Obviously, you'll know that under FCA guidelines, you can't promote anything, for example, on LinkedIn. But what you can do is talk about portfolio companies or give insight into your investment thesis. So you can either as a person or as a company build a brand on platforms, not just LinkedIn, but Twitter and other platforms. And that's, I think, an important part of the journey. And while it might seem like it's a sideshow to what you should be doing, which is investing, it does actually count because even a little bit of content often can end up becoming a bit of a library. So if you were starting out in January, say, and talking to investors and posting once a week or once a month on your thought process, by the time you get to June or July and if you're closing the fund and they look back, they can see actually there's been a journey and they can see your thoughts very, very clearly laid out. And I think that's something that people should consider. Number two is choosing your partners wisely. It makes sense to obviously really think about who we're going into ventures with. I was fortunate in that my partner was under my nose, as he's my brother. So we have a really complementary skill set and had invested together before. We did actually have a third partner at the beginning, and who was very, very successful in helping us with Fund 1. We parted ways subsequently, but that's part of our journey. And I think that you need to be looking at things at a very long-term basis. When you get into business with someone, you need to be trusting them with your money, because you're investing in a business personally, and building a very, very long-term business together should be based on strong foundations. I would go, obviously, to make sure that your roles are clearly defined with your partner. Mm-hmm. We at Love Ventures run the business off objectives and key results, and we have 4 main categories of OKRs. My brother leads on 2 and I lead on 2. So there's very clear definitions of where responsibilities sit, and I think that's important. In venture, you've got 2 customers, if you will. You've got investors and portfolio companies. Both are equally important, but you need to really work out who's specialising more on one or the other to make sure that you're keeping both of those communities happy. My background being from the city, I'm very comfortable on the investor side. So, frankly, you don't have a VC unless you're looking after investors, because you don't have capital to invest. So I would argue slightly that's number one, and slightly ahead of the portfolio companies, especially if you're starting out, because if you're trying to raise capital without it, you're nothing. Some would argue, if you're doing a great job in the portfolio companies, that the money will follow. But if you're starting out from day one, that's quite difficult to be actually to deploy. And thirdly, on the company side, build your pipeline, so while you're fundraising, you have something you can talk about to investors. So as you go through that fundraising process, and particularly towards close, you can say to investors, there's a good chance we might invest in this company, this company, and this company. So they have a clear idea of what they're getting into and can see under the tin. I think that's really important. There's another smallish point, which would be ops, operations, not to be overlooked. Choose your partners wisely. You need platforms, you need lawyers, you need folk who can help you as you build your business.
Yeah, fund managers, accountants, fractional CFOs, whatever it might be. Yeah.
Exactly. And there are lots of folk out there, and I think I would just recommend that you speak to those in your network, and you don't really spending too much time swapping those partners in and out. So maybe I consider it like a football team or a netball team. You're putting players in place. Try and get your A team together pretty quickly, and if you're able to be really strong, you've probably got an A team and a B team, so if something happens, you can swap them out. But we very much focused on that, a bit like a manager would, to make sure we're building out that team. And being brutally honest, as you grow, you're probably swapping out your weakest 1, 2, 3 players at a particular moment in time. So those would be my main recommendations. But the number one, going back to number one, is hustle. You got to really want this, and I've listened to an emerging manager on another podcast, and the one thing that they were saying is you've got to be fundraising for 4 years, and I think I would reiterate that you've got to really realize that you're going to be raising money for a long time.
Yeah, I like, as you're going through that, I'm sort of sitting there going, okay, like we could be talking about a startup as much as we're talking about a venture fund. And I think, yeah, look, we've had people on the podcast, famously Hussein and Rob Niaz at Hoxton. Took 3 years to raise their first fund. Took them a lot longer than they expected. We know others that, are raising their first fund at the moment. It's been 2 years in. And things are getting, things in the current environment maybe a bit different and difficult. And we'll talk about that in a little while. But, all of those things, I think, stand true whether you're building a venture firm or whether you're building a startup. I think thick skin and that kind of, I would reframe the hustle into maybe resilience or just, ability to stay the distance, because, to exactly that point, it is going to take long. It is going to, you are going to get a lot of no's. I mean, 84 investors from 900 probably sounds about right. Like from everything that I hear, 10% conversion. It's exactly the same sort of thing. If you're a startup trying to raise from VCs as well, you're gonna have a lot of conversations before you get to a yes, right? Hopefully, once you get to that one significant yes, a few others kind of domino on from there. But I think that's really valuable. I think on the operations side, and I think that's a bit that probably gets kind of less, well, it's less thought about in the sense that it's obviously not the sexy part of what you're doing. But I think, again, to your point, there are established fund administrators out there. There are established platforms that one can use. There are established players that can offer those ancillary services. What out of all of those, what was the most critical, like what would be the most critical kind of back office service that, day one, you're like, we need this in place?
Well, we have started out as a company mentor. So under the FCA umbrella, we were doing mentoring, and the investment manager was a company called Sapphire Capital Partners. So they specialize in launching funds and have around 15 or 20 funds on their platform. So we were introduced to them, and they came highly recommended, and they've been excellent for helping us start on our journey. We have then become an appointed representative through another company, and in due course we'll have our own FCA authorization. But if you're starting out and you are investing and you're in the UK, you need to consider that FCA authorization umbrella and who you're going to go with. So that would be the first thing. The second thing is those who look after the monies are the custodians. So we went with a company called Mainspring that has around 80 funds. We considered others too, but we decided that they had the best technology platform at the time for investors to be able to connect and find out what their investments were doing. And so we chose those partners fairly wisely, and particularly with a view to scaling. Yeah. Because you want to be able to do successive funds. As I mentioned earlier, we had a very small fund one. It was 1.7 million. So to be able to deploy capital fast and then do successive funds, you need partners that can go along the way with you and can scale on that journey. Yeah.
So, to your earlier point, you will ultimately need to swap out, the team, whether that's a partner in terms of a business or whether that's an individual, but you also don't want to be swapping them out at every turn, right? So you want partners that are going to be able to scale with you, and then at the appropriate time, they drop off. The other thing about Love is it is a venture fund, but it's within an EIS wrapper, right? And for our listeners, can you explain what this means and how it might differ from more traditional fund structures, if at all? Because I think there is, certainly EIS, a lot of EIS funds get a very bad rap because, often there are additional fees that they charge startups for the investment. So they may invest and then charge a 10%, annual kind of reporting fee or whatever it's called. And, a lot of those are essentially, funds that go out on a window by window basis, securing investment from EIS investors and then deploying. So yeah, could you give us a bit of a rundown of the differences?
Yeah, so the EIS is the Enterprise Investment Scheme. It was set up in 1994 and has been continued by successive governments since. And it's been very successful. At its origins, it's basically a tax-driven investment vehicle. So what happens is advisors and wealth managers advise their clients to invest in products such as VCTs, EIS, the AIMS, the alternative market on the stock exchange, and that is to plan and mitigate for tax and inheritance tax and etc. Now, there are obviously some good EIS managers out there, but what we found when we joined and started in the industry is that there are some lazy ones too who are collecting fees, like you're saying, and living off a name or reputation. So they collect monies, they take their fees, but they're primarily doing it as a tax mitigation strategy for their investors.
Now, rather than as an investment vehicle. Yeah.
Correct, absolutely. So we've approached it from an investor mindset, saying we are there to make returns for our investors, and if the tax incentives add to those and juice those returns, if you will, then that's an added gain. But we're not specifically doing it to create a capital gains tax exemption situation. We are doing it to make a capital gain. Mm-hmm. And if it's capital gains tax exempt, that's great. And most of our investors benefit from that. Now, what I would say is if we had spun out from, let's say, an established VC, we might have been able to go straight to an LPGP fund ourselves. We're not able to do that. That would have been falling flat on our faces. So we decided to go through what were our existing channels and our angel syndicate to raise through EIS funds. And we've been successful at doing that. And that is now going to be a strong platform and base on which we can then launch our LPGP fund. So that's how we've done it. But again, we've sort of coined that moniker VC with an EIS wrapper just to explain in simple terms who we are and what we do. And to finish on that point, what our observation is that although they can co-invest into companies, it does seem to be a little bit of a gulf between the EIS and the VC investors in the UK. I think the VC investors slightly look down on the EIS folk, and I don't think they necessarily need to. I think we're trying to bridge that gap, and we don't see why they can't work together. They're often on the same cap tables, but as we've both said, I think some of the traditional, more lazy EIS managers have got a bit of a bad rap, and sometimes justifiably.
Yeah, I think that there's two questions there's one question that comes out, and one kind of point. So I think, yes, they often are on the same cap table, and I think that's often the problem, right? Because sometimes those funds, those EIS funds, more traditional sort of funds, are so onerous on the startups that, more traditional VC investors kind of look at them and say, well, this is not actually helping the business, that, you're actually being a hindrance rather than help. Yes, you provided capital, but actually you're sucking out kind of management time and valuable sort of resource. But, to your point, the SEIS and EIS regimes here in the UK are massively beneficial to investors, and I would argue that we actually have a lack of traditional venture at pre-seed and seed, because they're essentially, well, certainly at pre-seed, because they're essentially taken up by EIS and SEIS investors. And I think funds that are able to provide that wrapper to investors who don't necessarily have the ability to generate the deal flow but are looking for those returns, I think that is really valuable, because essentially that is the pre-seed kind of activity that we're looking for from VCs. And I guess my question is then, for a startup, if they are raising investment from Love specifically, like, is there anything demonstrably different from working with you versus working with quote unquote a traditional VC?
Well, there is. I mean, we have a lot of expertise in helping companies get to Series A. So if I look at Fund 1, for example, we have half the portfolio that's reached Series A already, and it's only been fully deployed since July 21. So that's a 50% graduation rate. Top quartile VCs in Europe have something like a 40% graduation rate. So we're already above that, and we've only been going for a few years. And the reason is because we have a lot of expertise in helping companies on that journey. So getting Series A ready, what does that mean? Obviously, they've got their business model in place, and they've got unit economics working, others who wouldn't have invested. But it's helping them get access to the right investors that can help them on that journey. It's helped them as they launch new products and as they expand. It's helping them grow out their team. It's helping them with slightly boring back office functions like finance or legals. I can't tell you how many times we've seen legals which have come through from even larger VCs who are investing, and they're really not very good, and there are folk using platforms and others which are not really appropriate for Series A and beyond, and getting ready for more institutional investment. So we've seen that from our portfolio, and we've taken those success stories and those learnings and then helped those other companies along their journey. And by taking board seats in around 7 of 14 companies in Fund 2, we're able to really shape those strategies and help materially. The other thing that we've had from the outset, which really sets us apart from other folk and puts us in the same category as traditional VCs, is we've got a very strong advisory team. So our investment committees consist of myself and my brother, but 4 advisors, 2 of whom are in the UK and 2 of whom are in Silicon Valley. And 3 out of 4 of those advisors have worked in a startup. 5 out of 6 of the investment committee have worked in a startup. That's important because only 8% of VCs have worked in a startup.
Very few operators, certainly here in the UK compared to the US, yeah.
Exactly. So they've worked in a startup, and then also importantly, 3 of those 4 advisors have had an exit. So that's the holy grail, as you know, and to have that experience is very important. But we actually put that in place from the outset when we started in March 2020. And going back to the 2 that are in Silicon Valley, that's been a real help for us because they're taking the learnings from Silicon Valley and bringing them over here. So that's really what has set us apart. I don't think there are other EIS funds necessarily that are doing that or have that expertise that we have, and it puts us in the camp of those VCs, and it shows the added value that we can bring, because we're bringing people to meetings in strategy discussions post-investment saying, here's the menu of the scorecard, if you will, of getting to Series A. Here are the 1 or 2 things we're going to focus on. It's not going to be 10 at once. It's going to be 1 or 2. How can we help? And it's opening up your networks, your contact books, helping get the next round of investors in, helping with customers. Most of our startups are obviously trying to sell, but struggle with go-to-market and how they then actually put that into practice. And a lot of our Fund 1 was B2C focused. And as we've evolved, it's become more to B2B focused. B2B sales and partnership work is really tough.
Especially in enterprise, yeah.
It's really tough.
Yeah.
And that's where we found some of the struggle and where we can help the most. And it's where finding good salespeople has also been quite tough for them.
Yeah, yeah. Interesting. We had Zoltan Vardy on the podcast a few episodes ago, and he's closed, I don't know, something like $2 billion worth of deals over his lifetime. We talked about several of these sort of points in B2B. You have to think about how you go from local to global. So how do you scale outside of your first territory? How do you get the right logos right on as well? Like when you should say no versus yes. Obviously, how do you get to yes quicker? All of these sort of things are massively difficult. I think every deck that I ever see always underestimates in B2B how quickly they will build revenue, because enterprise contracts, and in the current environment especially, are going to take 6 to 12, if not more, months to close. And that is just the reality, irrespective of how amazing your business is. Just moving kind of on from that and talking a bit more about love, but in the broader environment. So you've just done your second close on the third fund, but we've heard a lot about the current funding environment, right, in general. So whether that's for fund managers or for founders, right? So how do you see this unfolding over the next 12 months? And what advice would you give to fund managers that are just getting started on launching a new fund?
So the market's obviously really tough right now. I'm old enough to have seen the 2000 and 2008 crashes, and I see investors who've still been burned by the latest bubble, which peaked in November 21. And the main issue is that when things get bumpy, investors retrench.
Yeah.
So they're likely to have to re-up into existing managers and are unlikely to allocate to new ones, except maybe big brand names who might be doing a new region or a new fund. So as an emerging manager, you're fighting against that backdrop to raise capital. So that's why it's been particularly hard, probably the hardest for at least a decade or more. In the startup fundraising world, it's also been very tough, pretty much for the same reasons.
It just flows down, right?
It just flows down, pretty much for the same reasons. But in some respects, I'm excited because those that make it through this period, particularly on the startup side, if they've been raising money in the last 12 months and they've done it successfully, who knows what they're going to do when it's an easier world. And so I'm excited by that. And for us personally, yes, it's been tough. But again, it'll get easier, and you have to single out those who are going to be taking a punt in emerging managers, because even in better times, there are some folk that won't be doing that. So you have to be in the right ballpark with people who understand that emerging managers often outperform. Yep. The earlier stage often outperforms. Yes, it's more risky, but if you can explain that narrative clearly to investors, then that's where you're going to find joy. And that's just an ongoing narrative. Where I see things going and my advice, so I think this is going to continue for a while. It feels like things are better if you have a quick look at the S&P 500 or NASDAQ.
Wait a few months.
Yeah, it looks pretty good, right? They've come back very strongly, but it's been driven by 7 stocks, and actually it's not a broad-based rally, and we're still in a tricky space. And so, again, back to my previous experience of those other crashes, I do think this is going to take a while. So people are going to have to dig in. It's going to be a tricky year, and with that bumpiness, obviously, and investors retrenching, it is tough. My advice is just to keep going. If you're raising a fund, you might raise less than you intended, but if you get to a certain level that you can close and deploy capital, I would encourage people to do that, because then you can build your track record. That's something you can go back to with investors. You're building that narrative and you're building that conversation with them over a long period. You can't just suddenly go, we're closing our fund in 3 weeks, are you in or not? It's going to take time. And the last thing is, if you're building up that track record, you're walking the walk, as they say. You can say, we have invested in these companies. Yes, it's not as large a check as we might have liked to have done, but we're still in that company, and then you're building your IRR and your track record. And finally, don't get too down. Everyone has to start somewhere. Sequoia's first fund was $5 million. Kleiner Perkins' first fund was $8 million. Obviously, with inflation, that's probably a bit higher than that. But this is where these great brand names and VC firms have started. So my advice is to get started, and if you're able to close the fund with a sensible amount, just to get going, rather than wait for an investor that might or might not come in the next 6 months.
I think what's really interesting as well is, you talked a little bit about this earlier about, building out your brand and obviously, building out that content machine that shows a track record and shows kind of how your thinking has evolved. But actually, I wonder whether over the last 5-10 years, actually, the reason that emerging managers are seeing such success or have seen such success, I think, is because people identify with the personal brand that they've built, right? So we've moved from companies as brands to people as brands, right? So companies as brands, you think about Coca-Cola, you think about Nike, you think about Sequoia as an example. Those yes, in some instances the people made the brand, but like I'd be hard pressed to tell you who the founder of Coca-Cola was. I know Coca-Cola. I know what Nike is. I can't. I don't think I've read Shoe Dog Millionaire, but I think you'd probably find very few people that could tell you who the founder of Nike was. But I think in today's environment where you have access to LinkedIn, Twitter, etc., you can build kind of brand and profile on there. The emerging managers, certainly that we've even had on the podcast, often it's because their personal brand is so strong and resonates so well that not only are LPs looking at them and want to invest in them, but also startups are coming to them because they recognize them, right? Whereas in the past, they may have recognized the big logos. Now, does a personal brand at some stage morph into the company brand? I think that's the open question. But I think what you're saying is I think you have to stay that distance, right? And you have to keep building that momentum at a personal level as much as anything else, because at that stage that's all you have, right?
Yeah, 100%. I think startup founders do target funds or brands, but I think they do also target individual investors and partners that they want to get on board to help them with specific domain expertise. So we've recently co-invested with a well-known VC where there's a partner there who specialises in platforms, and this is a platforms business. And I believe that that's going to be a huge added value to that company. It's one of the reasons we were attracted to it. But I think that's why that company singled out that partner. So yes, building out a brand on top of a VC is totally the way things are. You've seen the rise of solo GPs, so it is all about them. It is them as one person. Obviously, working with my brother, we're slightly in a different space, but there's been examples before us. Index Ventures was brothers, so we have brands that have built up VC firms with brothers, and we expect to expand. It's not just going to be about myself and my brother Adrian, it's about more than that. And the only reason that Love Ventures is the name of the business is we couldn't find something better. It's not because we're megalomaniacs, but we weren't going to spend a whole lot of money on advertising and on branding to go and find a new name.
Well, it's a pretty cool name. Irrespective.
And I think finally the last thing, you don't have to be the most liked person, but I think people want to work with you, and I think that's an important thing as well, because the way I see it is when you go into an investment and into a startup, the lifetime of that investment is probably longer than the average UK marriage, is the way I see it. So it's a bit of a scary stat, but it's true. You're in it for the long term. So just like we would choose our partners wisely in our business and also as our fund partners, as we mentioned, also for the investment into a startup, choose your VC partner wisely, because you're going to be working with them quite closely, and you need to have that bond and you need to have that strategic alliance. And yes, there are going to be ups and downs along the way, and it will be like a marriage, but it's a long-term journey. I've got an angel investment, which I invested in, I think 3 times, and they've just reached profitability this month after 7 years. So that's a long, long journey. And you are in it for the long term. You've got to be realistic. I was an angel investor in Revolut in their Series A round in 2015, 2016. Here we are in 2023, 7 years later, and I still have only taken a small amount out. We're waiting for the IPO.
And that would have been through secondaries, Yeah,
exactly. That was through secondaries, and I'm not fully liquid from that investment because I'm happy with it, but also because they haven't done an IPO, hasn't been that moment to do it. So you are in these investments for the long term.
Yeah, it's interesting. A friend of mine, someone who's been on the podcast before, I think now I can, certainly talk about it in the sense that it's happened. So Alex McDonald, who's founder of Velocity Black, they've just had an exit. I think it was announced 2 weeks ago to Capital One. That business was 9.5 years in the making, and went through the pandemic and everything else. And I think venture as an asset class, people hear about the large outcomes, but what they forget is the 10, 15 years that it's taken to get to them. So just as we wrap up, let's talk about another problem that a lot of folk have been talking about, certainly in the venture world, certainly in the investment world. But I think, the man on the street, and even someone like me, it's something that we've not really necessarily have understood fully, and certainly we haven't seen a huge amount of movement on, right? So you recently posted on LinkedIn that defined contribution pension schemes will reach about £1 trillion in assets under management by 2030, but to date has not really been able to invest in venture as an asset class. There's been a recent regulatory change which will start making that easier, but by no means are we kind of in the place where the US is. So why is this a big deal? What needs to change, and what does that unlock for the average person?
Sure. So there's quite a lot to unravel here. So we'll do it kind of bit by bit. Just to explain some background. So most VCs charge a 2% management fee. And traditionally, pension funds can't invest in this due to fee caps. Mm-hmm. So it's just been a complete no-go area. Mm-hmm. But there is now a recognition on the behalf of government and others who have been lobbying for this. So in particular, the British Venture Capital Association, the BVCA, to try and change this so the rules are changed so they can actually allocate into VC firms. And really what you've got to look at is the US model. So if you take endowments such as Yale, they've been particularly successful because they have over-allocated versus equities and bonds to VC as an asset class during a period when those funds have had outsized returns. So they've done very well. And the issue we have here in the UK is that if you have a successful firm and it's been building to, let's say, unicorn status and beyond, growth managers come in and invest, you're more likely to have a North American pension fund invested in that UK success story than, let's say, a UK pension fund. So it might be that a pensioner in, let's say, Canada is invested in a great growth story here rather than our pensioners here in the UK. So that's the real issue. And the allocation is still very, very low from pension funds, just in Europe generally, into venture. I think it's like 0.016 or 0.017% of allocation into venture. So there is an issue, a systemic issue that needs to change. And the reason it needs to change is because the average man or woman on the street is missing out from these higher returns. Now, we know that it's higher risk. We understand that. But in a portfolio approach of multiple funds, you can mitigate that risk. And what I've learned on this journey of building Love Ventures is that the difference between, let's say, the wealthier investors and the very higher net worth individuals or ultra high net worths is the wealthier they are, the more allocation they have to private equity. And I was quite surprised to learn that the largest ones have, let's say, 23% in private equity, which constitutes private equity, venture capital, alternatives, so it could be hedge funds, etc. And they have around 25% in equity. So they have almost as much in privates as they do in equity. I was astonished to learn that. Now, if you put that back to the average pension fund, traditionally you've had what's called a 60-40 portfolio, which is 60% equities, 40% bonds. As someone gets closer to retirement, it goes further into bonds, so they get they de-risk, if you will, some of their pension, but they don't have their allocation that all these wealthy folk do. So what we want to do is really democratize VC. We're not the only ones that want to do it. There is a movement to do this. An example might be, for example, Crowdcube that recently launched, I think it was a VCT where the entry level was about £3,000, whereas normally it would be much higher than that. I think it was an Octopus product on the Crowdcube platform. So there are people who are trying to democratize VC. My dream and my vision of where we go to is that when someone allocates into their pension and in their pull-down menu, they have your traditional large funds, so Fidelity and all these other large firms. There might be some VCs in there too. It might be some larger, well-established brands and some big names, and hopefully some emerging managers too. And I'd love for us to be in there, but also others too, that people have a choice. I know that the FCA will put a great big warning sign all over it saying this is higher risk, and they are absolutely right in doing that. It is higher risk. It's also a higher reward, and we know over the long term that actually those rewards can be greater than other asset classes, which is exactly what Yale have done so successfully.
Yeah, I think the high risk, and maybe this just comes down to being an entrepreneur or whatever, but the kind of high risk caveat, like, yes, obviously it makes sense and that warning needs to be there, but I also feel like there is just far more information out there, so that risk is less nebulous. I think in the past, like, it was such an opaque asset class, right? That many people just wouldn't even understand what does it mean to invest in a startup. But today, you know, the FT is reporting on what's happening in startups, right? You know, The Economist and other, obviously, newspapers of record. You know, there's a lot of, I think, unfortunately, and in the UK certainly, but probably, you know, as a global phenomenon, there are lots of papers and tabloids that really kind of denigrate the asset class as well. We've seen it recently with all the very, very bad takes on, say, the Future Fund, where you know, all the news has been like, oh, you know, this company has, you know, whatever, I think 5% of the 8%, I think it is, of the Future Fund of businesses that took investment from the Future Fund have since collapsed. That's actually not a terrible outcome in terms of venture, right? And all it takes is for one or two of the remaining balance to really have an amazing outcome for that to have been exactly the right way forward. And I think if there is more education out there as to kind of, you know, how, to your point, how that risk is balanced by outsized returns, then I think, you know, people can start getting more and more comfortable. I think the fact that, you know, most people don't think about investing in venture because most people only think about, well, I've got my pension fund, I've got my ISA, that's it. I don't have time to think about this other stuff. If they could, on the other hand, you know, use those vehicles and invest in venture as an asset class, I think, you know, they would definitely, benefit and be eager to do so, because it just means they don't have to then look for deal flow, go out, find other things. They can just do it directly. Marcus, it's been absolutely wonderful having you here in the studio with me today. For our listeners, where is the best place for them to find you online? Are you on LinkedIn, Twitter? Where can they find you?
The best place, I am on LinkedIn and on Twitter, but we're more active on LinkedIn. That's the best place to find us. So it's Love Ventures. Obviously, through our website, we give some insights into some of the investments we've made as well. So people can find us there too.
Amazing. Marcus, thank you so much for joining me in the studio.
Thank you so much for having me.